We certainly do have plenty of volatility, which reflects all kinds of uncertainty. Investors that can't handle the short-term nature of the volatility probably don't belong in equities, because people shouldn't be in equities for the short term. They should decide what their long-term objectives are. If equities have a piece in that, put the money in. On dips, if anything, add some more, but don't panic.
BlackRock likes a portfolio of both cyclical and defensive stocks.
We like a defensive sector and a cyclical sector for 12. Our defensive choice is healthcare. We think it has the best risk-reward, good, cheap stocks with reasonable earnings prospects. And on the cyclical side, we like the energy stocks. We think energy is cheap relative to the market, to the price of oil, and it gives us an insurance policy should something messy happen in the Middle East.
When it comes to growth versus value, BlackRock goes for growth.
When growth is scarce, which it is in a slow growth world, that's usually when investors are willing to pay up for growth. In addition, growth sector tends to be a bit cheaper at the moment than the value sector, so for both those reasons we prefer growth over value.
The U.S. can avoid contagion even if Europe is in a recession.
The decoupling scenario, the divergent scenario we're talking about, has U.S. growth acceptable this year, 2+ real growth, while Europe is in a moderate recession. So look, Europe's recession, if that's what they're in, does not help the U.S., but we think there are enough other good things going on that the U.S. can escape the contagion from the European slowdown.